whenever I was selling investment properties, people would be like, well, what's been the growth rate in your area? What if property values go down? And then I thought to myself, well, I don't plan to sell this in 3 or 5 years. I plan to keep this over a long-term period. So that question is actually irrelevant. So if you start looking at things over 30 years as opposed to 5, 10, 15, the longer you spread it out, you will make money. And the beautiful thing about real estate, and Shannon, you brought it up, just the fact that we're not going to have any problem renting it, is that we get actually attach an income stream to that.
Welcome to Real Estate for Real People, hosted by Shannon and Tamara Stone. As award-winning real estate professionals, the Stone sisters have spent years helping people navigate the complexities of buying, selling, and investing in real estate. From first-time homebuyers to seasoned investors, Real Estate for Real People is the go-to resource for anyone looking to make smart decisions in the world of real estate. So sit back, relax, and get ready to learn from some of the best in the business.
Hi, everybody. Thank you again for joining us for another episode of Real Estate for Real People. Shannon and I have got a great guest with us here today. It is the one and only Alex J. Wilson. Alex is with Remax in Toronto. He is the president. Alex, would you say the owner, the founder of Wealth Builders Real Estate?
Broker owner, president, founder. Yeah, that all works. That's me.
All of the above. Well, this will be great. We're excited to have you on board, and you're going to talk about what your company is, wealth building through real estate.
Yeah, and so obviously I'm a real estate agent. I've had success with that. In 2022, I was the number one Remax realtor for individual closed transactions in Canada. I've achieved all Remax Circle of Legends. I'm a Pinnacle Club agent, but none of that actually matters about the topics today because it's all about real estate investing. And that's how I've grown my career. And that's how I've been successful, is showing people how I've invested and then telling them to follow in my footsteps. And I've built a $20 million real estate portfolio. And that was all on initial investment of $39,300 on a pre-construction condo in Calgary, in Toronto. But we will talk a little bit about Calgary. But the cool thing is I'm just from a small town in Northern Ontario, a town of 4,000 people. Anyone on this call that's listening today can do what I've done, and I've done this over a 10-year period. So we're talking in simple terms, and that's what I like real estate. It's simple. You invest in a roof over someone's head, and then they give you rent to live in there. And that's as simple as it comes.
I agree. Love it. Amazing. Mm-hmm. So what's how do we dive into this? How do we start? What's the trick?
So the first thing is buy real estate and hold real estate. So whenever I do webinars and show people how to invest in real estate, I tell them there's no quick money in real estate. If you're trying to make quick money in real estate, you're setting yourself up to lose money in real estate. The great thing about real estate is you could actually never lose money in real estate. And the only way to lose money in real estate is if you sell. So never set yourself up to sell. So never think about getting into real estate short term. Always think it as owning over the long term. So when I look at my real estate portfolio, I look at it in 10, 20, and 30-year increments, and specifically in 30-year increments. And why I look at it in 30 years is that if you're buying an investment property, that means you're putting 20% down on the property. And if you put 20% down on the property, you can amortize your mortgage over 30 years, meaning that each payment every month on your mortgage over 30 years, that property will be paid off. And the beauty is that property has been paid off by someone else. There's been someone that's been living in the property, and that money covers your mortgage interest, the payback on the mortgage, any maintenance on the property, any insurance, all your extra costs. So that rent is covering the property. And the great thing is in 30 years, that person or people that have lived there have paid off the property. And every year that property is going to go up in value, and that value is going to compound any year. So we're going to have compound annual growth. I look at just a simple 3% compounded annual growth rate on my portfolio. And when I look at the value and when I do my seminars, the number on the portfolio was 17 and change, which, yes, I have a $20 million portfolio, but I know my number is based on 17. I'm constantly buying. So 17.3 million roughly. And in 30 years, that portfolio compounded annually, 3%, it'll be worth over $42 million. What's cool is that, yes, my portfolio is 17 million and change now, but there are mortgages on that property. But in 30 years, there is no mortgages on the property because those people that have lived in the property have paid off those properties. So I have a fully paid off property that's gone up in value that I didn't pay those mortgages down. Someone else paid those mortgages down. And I don't view mortgages as debt. I view mortgages as leverage, and leverage is key. Now, when you have a mortgage on the house that you live in, that's debt because I can't deduct the interest on my personal residence. But on an investment property, that interest is tax deductible. So I'm leveraging that property and I have an asset that's going to go up in value and I don't have a full 100% down on that property. I only have 20% down on that property. And that's where you can really see big gains. And when you take two finite resources, one finite resource is time. So unfortunately, I have bad news for everyone on this call. You're all going to die. But that's everyone on this call. So that's one finite resource. Number two, land is the other finite resource. We're not making any more land. So we apply two finite resources, time and land, we can build significant wealth. And I start every presentation off where I go dissect my portfolio and show people that so they get in the mindset. Because a lot of people will come to us and like, oh, I want to buy this and I want to sell them in 3 years. Like, why would you want to do that? Because if I show you how much you're going to be worth in 30 years, that's the key thing. And then when you start looking at it in $1 million, $2 million, $3 million increments, if you have a $1 million real estate portfolio today, $1 million real estate portfolio, which may seem like a lot, but it's not really when you think of it as, what's your average resale price in Kelowna, for example? $1 million, and let's say a condo. So that's not even two condos. That's your $1 million real estate portfolio. So just $1 million real estate portfolio, or let's keep it easy. One house. So if let's say you have two houses in Kelowna instead of one house. If you have two houses in Kelowna, that second house in 30 years will generate you $70,000 of after-tax income. Sorry, not after-tax. It'll generate you $1,000 salary in 30 years. And how I work that out, and that's in today's purchasing power. So what I did is that I looked at, a 3% compounded annual growth rate over 30 years on $1 million real estate portfolio. And then I adjusted for inflation. So I actually know what the inflation number is, or I just look back in 30 years. And then I apply a 5% rate of return on what the value of the property is in inflation adjusted numbers. And I get $70,000. I could pay myself $70,000 a year by owning that extra property. And that goes into the mindset that I teach people, is that you can actually build your own pension plan by owning real estate. And then if you look at a $1 million increments, if you do 2 million, well, that's 140,000, and then so on and so on and so on. So you don't need to have a $20 million portfolio like I do, but if you start taking $1 million bite-sized chunks, again, we're using leverage. So to have a $1 million investment house, that's a $200,000 down payment. So now, so to have $1 million today, all you need, $1 million asset today, all you need is $200,000. And that's the power of leverage, and leverage over time. And we know that if we're investing in the right locations, where we do look at population growth, if you're in an area where you expect to see population growth, this formula does work, and it works across Canada.
Mm-hmm. 100%.
What's so nice is that you see that, you can purchase a property, you're not having to worry about the ups and downs of the market. You're looking at rent. And when we see the amount of our population growth with the amount of people that are going to be moving into Canada, I don't think there's going to be any issues with renting a property. I think we're going to continue to see low vacancy across the country.
That's absolutely it. And that's where it was a really big aha moment for me a few years back when I realized this, because whenever I was selling investment properties, people would be like, well, what's been the growth rate in your area? And what if property values go down? And then I thought to myself, well, I don't plan to sell this in 3 or 5 years. I plan to keep this over a long-term period. So that question is actually irrelevant. So if you start looking at things over 30 years as opposed to 5, 10, 15, like just the longer you spread it out, you will make money. And the beautiful thing about real estate, and Shannon, you brought it up, just the fact that we're not going to have any problem renting it, is that we get actually attach an income stream to that. So yes, we're taking a mortgage, which has an expense, but I have an income stream that's attached to it, which is going to offset that expense. If I were investing in the stock market, other than dividend-based stocks, what income stream can I attach to a stock? And this is where, and I own stocks as well, but the majority of my investments are in real estate. But if that stock goes out of business, or if that company goes out of business, I can lose everything. If the real estate market goes down, it will go back up. It always goes back up, especially if we're investing in markets that we know that we're going to see growth. So let's use your market in Kelowna. I'm not worried about Kelowna. Kelowna is a fantastic location. Kelowna has some nice natural barriers to it as well, which does create some legitimate land scarcity in the fact that I have water and I have mountains. So there is only a certain geographical area that I can build in, and if I want to live in Kelowna, here is the area that I can be in, and that we know that if we look at immigration and we look at demographic trends in regards to, hey, maybe I don't want to live in a big city. I'm downsizing. How many baby boomers are downsizing are going to be looking at leaving their homes? And how many people do you have come from Ontario and Vancouver over the pandemic? Probably a lot.
A lot. A ton.
So it is interesting, Alex, just sitting here listening to you, because I think Kelowna has some key things in that we've got a great airport that continues to expand, and we've got a university and a teaching hospital. So big hospital. We've actually got some care here, some cancer care that's available only in Kelowna, nowhere else in the country. So I think those are some key things that people are looking for.
That's massive for wealth-based individuals that are looking towards their next move and where they're going to live in life. And if they don't need to live in Toronto or Vancouver, Kelowna offers incredible value for them and a great lifestyle for them as well. And then you get that.
Now population. When you look, when we listen to reports or do some research as to where people are immigrating to, I think 2023, they're forecasting 500,000 people. Have I got that correct? Into our country. Majority of people go to Vancouver, Toronto, and Montreal. Am I correct with that? So that's, what are the markets you see, Alex, for opportunity?
Okay, now you're going to get me excited in a good way. So I'm based in Toronto. I'm literally downtown Toronto. I'm right on Bay and Queens Quay. We're right on the water in Toronto. But Toronto is incredibly expensive. Vancouver is incredibly expensive. So you gave your number of Kelowna. Average house is $1 million. If you said Alex, I want to live in Toronto for a house for $1 million. Let's say a detached house for $1 million. Can't do it. It's a piece of land. So it's more expensive here. So now we'll go, okay, well, if we have new Canadians coming in here, where are they going to live? Well, again, Toronto, Montreal, Vancouver, they're all expensive cities and they lack affordability. And you guys know me, so you know where I'm going next with this. The second most affordable city in Canada and the ninth most affordable city in North America is actually Calgary. So we've been turning our attention to Calgary since 2019. This was before the pandemic. And I really saw Calgary being far too low in regards to the value, in regards to what the city had to offer, in regards to they have the fourth largest economy in Canada. Their economy is larger than whole provinces. It's larger than the province of Saskatchewan. It's larger than the province of Manitoba. They have the fourth largest population in Canada. They have the second most head offices in Canada. They have a true international airport. So that goes Toronto, Montreal, Vancouver, and Calgary have international airports, and that's key for head offices. And they have a strong backbone, which is oil and gas. But they've been diversifying their economy for a while. So they have a really large tech sector that's been growing and have been diversifying in other areas. So they also have the highest wages in Canada, the highest salaries in Canada, and the most millionaires per capita in Canada as well. So a lot of positive things in Calgary. Yeah, there are a lot of positives there. Now, it was the issue was that the value of real estate in Calgary went down because the oil gas prices crashed in 2014. You had mass layoffs. And when you have mass layoffs in the oil and gas sector, that's housing prices went down. But again, they diversified their economy. So when we started investing in 2019, again, Calgary was still associated with oil and gas, which it still is today. But we saw like, wow, it's really affordable here. And they don't have the same closing costs that we do that we have in specifically Ontario. And I know BC has extra closing costs as well. And that's when we started buying there. When you can buy detached homes for, at the time, I bought in 2021, I bought a brand new detached home pre-construction for $525,000 in 2021. And then I sold it in 2022 for $720,000. And still those numbers are cheap, both those numbers, even at 720.
Now, a question I've got for you though, Alex, is Calgary, my perception anyway, is that they're boom and bust. So their vacancy rate is really quite volatile, whereas ours has stayed at less than 1% for the 29 years I've been selling here. I know I've got some friends who have properties in Calgary that have sat empty for nearly a year. Just when things fall down, people do move away or go elsewhere. And I guess you just factor that into your equation or plan for it, or what's your advice there?
StatsCan. So when I look at statistical demographic data for population growth, the population of Alberta is going to grow by 48% over the next 2 decades. So by 2043, it's going to go by 48%. Ontario is going to grow by 24%. Alberta currently now, and I flip-flop these stats a little bit, so if someone fact checks me, the end number is going to work. But Alberta currently has 400,000 people less than British Columbia right now. In 2043, it's going to have 600,000 more people than British Columbia. Or the other way around. It's one or the other. But it's a net swing of 1 million people. But what's cool is the city of Calgary, which is the population and economic hub of Alberta, it's going to have even larger growth than that. So it's going to grow by 62.5% over the next 2 decades and grow by 1 million people. So it's going to go from 1.6 million to 2.6 million people over the next 20 years. All those people will need roofs over their head. And that is Statistics Canada data. That's not my data. That's not me cherry picking data in regards to some website. No, that's directly from the government. Now, why are we going to see that growth? Again, it's affordable. It's incredibly affordable.
Well, and they've got land. I was just there, promoting our listings, and it's amazing that there is so much land. The road system is amazing because you can get from one end of the city to the other quite quickly because the roads, the
grid system, the way it's laid out. Mm-hmm.
I kept thinking I was on a highway, and so I was going, sort of highway speed, and then realizing, oh, this isn't a highway. It's just all the roads are big, and they've just got so much space that they're all beautifully maintained, and so it is interesting. Plus, 2 Alberta tenancy rules
they're
are a little bit
hard.
more for the landlord than
Oh yeah, and again, that's where the confidence comes into play. And I've already seen it happen in the States. And what I mean by that is when I look at America, I see companies moving away from Silicon Valley and they're moving to environments like Texas and Florida. And I look at why are the reasons they're moving away from California and New York, the state as well. And the reasons are, number one, tax. Okay, so if I look at, what's the best tax-based environment in Canada? Well, that's actually Alberta. Alberta has the lowest corporate tax rate in Canada, and they have no provincial sales tax either. On top of that, when we're talking about Calgary, and again, Alberta, if we're talking from a real estate perspective, there's no land transfer tax either, and there's no extra development charges that builders have to pay. When I close, and there's no HST rebate that I deal with, that's something I deal with on material. When I look at if I'm closing something in Ontario and specifically in Toronto, so Toronto, we have a municipal land transfer tax on top of a provincial land transfer tax, which just from a government perspective, I'm paying 4% of the purchase price to the government right off the bat on closing. And then with my extra development charges, which can be tens of thousands of dollars on top of that, I could have a bill of $60,000 on closing just on extra charges. Where it's zero in Alberta. So there's huge affordability there. And going back to that affordability, we're talking about the traditional boom and bust cycle in Calgary, that was based in oil and gas, which those layoffs happen. If we look at where the current boom is right now, it's not oil and gas. I started buying in 2019. There was no COVID. There was no conflict in Europe with Ukraine and Russia impacting oil prices. There was none of that. I already saw the changing of the market in order to diversification to the tech sector. Now, yes, we have oil and gas, and we've had prices that are up, and I do expect a long run on that. That's going to be positive for Calgary, especially with the Trans Mountain pipeline that's opening in 2024, which is going to help gas. And I won't get into all that. That could be a whole other conversation. But the economic positives are great because what's caused the boom and bust cycle before has been solidified. There's been diversification in the economy. And what I say to people is people are like, well, what if oil goes down again? Like, doesn't matter. You can't lay off people that have already been laid off. Those people that were laid off didn't get rehired. There isn't massive investments in oil and gas in Calgary and Alberta right now. That's not what they're investing in. They're not opening new big oil sand investment patches. Those people haven't been rehired. They have been put into different areas of the economy. So that's where I see the long run. Now, again, affordability. I'm not moving away from Toronto. You guys aren't leaving Kelowna. We have families. Our roots are established. Okay, but what's different though this time is that people that are in their 20s and 30s that don't have those established roots, they're like, wow, these other cities are really expensive. I can make just as much money living there. I can live a great lifestyle being in the base of the Rockies. Why don't I go live there?
Well, a perfect example, Alex. My eldest daughter will graduate university next year. She's got one more year left. And, she'll have an economics degree. She's looking at different options and fully planning that she's going to move to Calgary for the reasons you're talking about, for wages, for the cost of housing, the fact that she's quite close to Kelowna and thinking, okay, well, that's where she'll be.
And that's when you go back and look at those traditional boom and bust cycles, the pricing of real estate, if we go across Vancouver, Toronto, and Calgary, they were much closer then. And now there's a huge disparity in regards to values. So that's when you could have people leave the area. Now there's a whole economic motivation. Now going back to all these new Canadians, so it's 500,000 new Canadians. Well, where are they going to move to? Yeah, Toronto and Vancouver are going to get their people. But this is where Calgary is going to take an outsized role. Going to take those people in because again, you're looking at brand name cities, Toronto and Calgary. Toronto and Vancouver. I'm like, wow, that's really expensive to live here. Well, Calgary. Oh, I can make this. I can do this, but it only costs me this to live here. And I have an international airport. I'm going to move Calgary, and that's where you're really going to see the demographics continue to change in Calgary and become a true multinational, multi-ethnic city in Canada. So I see outsized growth in there. But that's also, I like Calgary a lot, and or like the cash flow fundamentals. But you can really apply to what I was talking about to any location that you're in, as long as you see you see population growth in that center and strong economic growth in that sector, you'll see increases in value in the real estate. So again, going back to Kelowna,
what was interesting,
I see upside there.
Yeah, it was interesting, Alex, when we were in Toronto, when we were at our last seminar or what have you, when we were all together. And we were all just talking about, you were sharing with everybody your philosophy on investing. And we really all got into a discussion across, all different markets about that. And I found it so fascinating that, talking to a realtor that's in Vancouver market and to yourself in Toronto market, that your investors, you do have investors that are buying in your market, but they're buying only for the fact of really seeing that property go up in value, not really to carry itself.
No, you can't.
And, whereas you can't. So you're just, people aren't buying for that. They fully plan that they're going to have to supplement that property. Whereas, you look at buyers that are in the Calgary market, going to that Kelowna market, and being able to purchase a property where, Kelowna is getting tougher, but certainly you're not having to, put out a whole bunch of cash anyway to keep it going. So interesting, just the different markets across Canada.
Now, a question I've got, Alex, just for a moment, I'd love to talk about the problems with this. So, and not that there are huge problems, but tenants, there can be issues dealing with tenants, and particularly when you've got a $20 million portfolio. I don't know how many properties that is, but logistically, how do you manage that? Do you have a property manager? What's your advice for our listeners with regards to that?
That's a great question. And yes, I do cheat. I do own a property management company. So yes, I do have a property manager. But I will answer this in the way in that you don't need a property manager. And this is where it depends on what asset class you're looking at investing in. And to give people a perspective, I own condos. I own I'll break it down. I own 15 condos, a triplex, an apartment building, and I just bought an office building, but I'm going to owner occupy that. But the most scalable option is condos, because condos essentially are concrete boxes in the sky. And if I buy a condo, all I'm responsible for is basically what's inside those four walls in that interior space. So biggest thing that goes wrong in a condo is appliances. Once I get into, let's say, single family properties or multi or a triplex in that case, I'm responsible for, again, what's inside those four walls. Then I'm responsible for what's inside those walls. Then I'm responsible for the exterior of the property. Then I'm responsible for the land the property is on. That's a lot of stuff to be responsible for. And anyone that's on here that owns a house, I think we can all agree houses are a pain in the ass. So those can be much, much more work. And the only reason I own the triplex is I used to live in the triplex, and then we bought another house down the road from it. So it was manageable to maintain because I physically lived in the property that had two rental units in it. And now I'm just literally a block away from that property. And by far, the most issues come from the house. By far. It's not even close. The condos, I get certain condos where I don't even get a call from the tenant in the entire time that they're living there. And again, typically the only calls we get, there's an issue with the appliances. And what appliance is it most likely? The dishwasher is most likely the issue. So I would say is that if you want, and most people I find are busy professionals that want to own real estate but don't really want to be involved in the active management of the real estate, that the best asset to buy that has the least amount of involvement would be that concrete box in the sky, the condo. Can a single family home make you more money or its appreciation? Absolutely. But guess what? There's much more active management with it. So I will go back to one of the first things I said in the beginning of this recording, is that you only lose money in real estate if you sell. So don't sell. So don't put yourself in a situation that sells. If you're buying a single family home, but you don't have the capacity to manage the single family home or a property manager that can manage it for you, you then will put yourself in a situation, if you're too stressed out, that you will sell that property at the time that is not ideal, and you could potentially lose money because the opportunity cost of your mental health or your ability to maintain this property will outweigh the actual cash that's involved. So that's why the majority of our investors like condos. It's because they're easy. And even if you have a difficult tenant in one of those, there's not much they can do in the property. And that's where the scalability comes up. So and then I'll say one more thing on that. It's not hard to rent a property. It's pretty easy. And it's pretty easy to make sure you get a decent tenant in the property. There's two things you need to do. Two things. Run a credit check. You run the credit check on the person, and then get their employment information, and then validate their employment information. If you do those two things, you're going to be okay. If past references from another landlord could mean nothing, it's those two things, the credit check and the employment validation. If you do those two things, you'll be fine.
Smart.
Yeah.
I like
amazing.
that.
This is such good advice, and it is exciting. Of course, we look at the Kelowna market, and I think there's lots of potential to invest here. I'm just looking at what's the growth going to be for our local market and where our price point is and where we project, especially if you're holding on to something for 30 years. Where will Kelowna be in 30 years? I think it's going to look completely different. So, but neat to know about other opportunities. And I certainly can see Calgary being an exciting one as well.
Alex, a question I've got for you before we let you go. Is there an ideal size? Do you buy 3-bedroom condos? because they rent for a bit more? Do you go with a 1-bedroom? Do you do 2 because that's sort of the norm and that appeals to the broadest audience?
Right now, what I like is, and it really depends. I'll back it up. It really depends on the market. What I do in Toronto is going to be different than what I do in Calgary. So in Toronto, I own studios up to 3-bedroom condos. In Calgary, I've only bought 2 bedrooms because of the affordability. I'll answer this. What I do like is with COVID, I do like a floor plate that I can have either a 2nd bedroom or a den, because someone is going to want to work from home sometimes and have a space that they can work from home. Also looking at affordability, depending on your market, if you can push into a 2-bedroom, you can, because I do see people cohabitating more especially in more expensive markets. And that's where that 2nd bedroom comes into play. And I'll add one more thing, and this is to the parents out there. I highly encourage you to buy a property for your child to whatever market they are moving into, and then buy them a 2-bedroom unit. Don't buy them a 1-bedroom, buy them a 2-bedroom unit. So if you buy them a 2-bedroom unit in their early 20s, and then what they can do is they can rent that 2nd bedroom out to a friend to offset the additional costs on the property, you've really set them up for success. So they can actually buy that white picket fence home when they get into their 30s, and maybe when they do that, they can still keep the condo as well. That down payment, when that first property you buy, isn't your forever house. That's your down payment for your forever house.
I love that.
Yes, I love that.
That's my advice to people. And then if you're really ambitious, buy a multiplex like I did and live in there.
So good.
Smart. Such great advice, Alex. Thank you so much. That was
no problem.
Yeah, great information and exciting. So we're going to see, and something I want you to share, because you had shared this on one of our chats, was the number 1 researched place on MLS Canada. And what city is that?
Oh, that was actually Calgary. So the number 1 market that's being searched on realtor.ca is Calgary right now. So I do highly recommend that you look into that market. And I still see tremendous upside. And if you just look at the affordability, still there. Prices have gone up significantly. There's still huge room to go if we compare them to the Toronto and Vancouver markets.
Amazing. Alex, where can people find you? If people want to follow you or learn more?
Yeah, come to our website, remaxwealth.com, or you can follow me on Instagram, wealthbuildersre. That's at wealthbuildersre. But again, also remaxwealth.com is our website.
Fantastic.
Awesome. That is amazing. Alex, thank you so much for joining us.
Yeah, that was great. It was exciting and interesting.
Take care.
Thanks, Tamara. Thanks, Shannon. Appreciate it. Bye-bye.
You too.
Bye, Alex.